Ben, let me start with you because, I mean, you got FANG basically up 20% from those Christmas lows, and we got Netflix tomorrow. How much of this is going into the earnings season with too much optimism, maybe, or not enough?
Well, I mean, I think things got a little bit out of hand in the fourth quarter as we saw growth sell off tremendously, particularly in December. You know, we put out a piece on Netflix last week. We remained bullish on the stock. Obviously, their decision to raise prices, I think, really reinforces our view that this is the year free cash flow burn will peak. And I think that becomes sort of a next piece of the story for that stock as we move through this year. So ever since we've been covering Netflix, you've wanted to buy every big dip, and that continues to be our approach. So we still like the stock despite the run it's had since mid-December.
Does their strategy necessarily change if, in fact, free cash flow burn does peak?
No. I mean, the strategy, I think, is to make a lot of money long term. We've always felt like this was a business that could be highly cash flow generative. They actually will generate, we think, close to 13% operating margins in 2019. So it's a profitable company from a P&L perspective. And the focus on cash flow, which is what the bears tend to focus on, I think has really been a little bit misguided in that it misses the timing of TV and film production spend. But as that goes away and fades into the background, we're really left with a business that has pricing power, which is unique in this market, and a big global opportunity still ahead of it.
Mike, how important are Netflix earnings tomorrow in terms of setting the stage for broader FANG and tech stocks?
I think Netflix earnings themselves maybe got slightly less important because we got that move on the price increase, which maybe I think people tried to infer that subscriber trends must be okay if they're going to make this move right now. But in general, I think Netflix has separated itself as a storyline from the rest of FANG. But in general, the appetite for the big growth stocks, the old ones that worked, last year so well for most of the year, I think tells you it's much more just of a refreshing of risk appetites in general. That's mostly what we've seen, I think, in the last 3 or 4 weeks is, okay, people were able to decide that was a downside overshoot in the markets. The credit market did not tell you there was something broken in the system, and so we're just going to take it back up. Now I think the question is, you've kind of unwound that overshoot. You're back at this level that you were at in early December for the overall markets, for the NASDAQ and everything else. Do you have the horses to take it past it without much of a rest or a pullback? That's the question, I think, for today and tomorrow as we get more of these earnings.
Ben, give us your take on the streaming landscape overall. We heard about our parent, NBC Universal, entering the fray with this service that's going to be free with authentication that you're already paying for cable, paid for others. Is this all about original content, what's going to make all of these succeed, or are the models going to be necessarily different, whether you're ad-driven like NBC and some others, or subscription-driven like Netflix?
Yeah, I mean, the world is changing at a rapid pace. It makes it a lot of fun to be a media analyst, and it's a great time to be a consumer, but tremendous uncertainty for investors. You know, I think what NBC announced is interesting in 2 ways. One, it's different. You know, it's ad-supported largely, and it's also going to be given away with the overall pay TV subscriber base for Comcast and Sky. So it really plays to the company's strengths. The real question to me with NBC is, how do they think about licensing their content going forward? Are they going to be pulling stuff off of third parties and moving it onto their own service? We have a piece out this morning, actually, on the cable satellite industry, and in that sector, Comcast is our top idea for 2019. The stock, from a PE basis, is about as cheap as it's been since 2012. So on the streaming side, which you asked about, Netflix and Spotify are 2 overweights we like a lot. In the more traditional cable media world, Comcast is a top name for us.
Ben, to that point, I mean, in terms of pricing, obviously we've got this Netflix price increase. I think there's probably a lot of folks out there that are, subscribed to Netflix, myself included, $13. Okay, whatever. I'm getting a lot of content. It still seems like a good deal to me. But when you have Amazon, when you have Hulu, and now you have Comcast, AT&T working on something, Disney, potentially Apple, plus you got ESPN Plus, you got HBO. I could just go down the list. At some point, there's going to be a ceiling in terms of the prices that Netflix and all of these other companies can charge. Any sort of insight on what that might be?
Look, I think it's a great question. I think if you look at what's happened, we already have, we think, about 150 million OTT subscriptions in the United States already. So the consumer likes this delivery mechanism, this way of consuming content. But one point we make in our Netflix report last week entitled For Your Consideration is that TV is the addressable market here is much larger than just streaming. There's a tendency to pit Disney Plus and Netflix and Hulu together. It's a $500 billion global market. Most people around the world watch pay TV in a traditional cable satellite package. That's really where you're seeing share erosion. So there's a lot of room for these services. Having said that, I think we should not underestimate what Netflix has and is accomplishing. It's going to be very hard for other companies to pull that off. And I think you've seen that in NBC's approach to the market. They're really not trying to go down that path. So we continue to think Netflix is going to stand ahead of everybody else. And then there are a couple other companies with opportunities to scale something. They're not going to be transformative. But I'd put NBC and Disney in that camp as having a good opportunity to build an asset that makes money over time. But it's really a Netflix and a long list of smaller players, I think, for a while on the pure streaming front.
I think one question is, having spent the last year obsessed with M&A game theory and to a lesser degree regulatory game theory, if we get back to classic ad trends, right, or sub-trends, things like in terms of trying to find valuation?
Yeah, I mean, I think we're kind of getting in that area. If you view the whole thing as really one market, you know, pay TV or internet TV is all kind of part of the same thing. Yeah, I think that's roughly where we're going. Not to say you preclude the idea of there's going to be the pieces move around, CBS, Viacom, all the rest of it. But what's interesting is another way to look at the Netflix move is to say, look, clearly there's some finite absolute number in terms of amount people can spend for streaming. Or for pay TV in general. Why not use your advantage now, get a bigger piece of whatever that number is that we don't know? That's also your raw material for the content because Netflix feels it's already made itself indispensable in this world. So I do think that, you know, used to be, it's funny, when you look at what kind of companies have pricing power, it used to be cable. Right? I mean, it's not that unusual to have this kind of idea out there that you can have sub-growth plus some pricing and then ad trends, you know, GDP plus. So I think we might be kind of back to that mode of analysis again.